Have you ever wondered how Canada, the country of hockey, maple syrup, and being super polite, also became the absolute world leader in funding mining projects? Well, it's not by accident. It's actually a fascinating story of some seriously smart and maybe a little sneaky financial engineering built right into the country's DNA. And just to give you a sense of scale here, we're talking about the Toronto Stock Exchange listing over 700 mining companies. That is more than any other exchange on the entire planet. It's the world's go-to place for anyone looking to fund a mine. So how did this happen? Was it just luck? Not a chance. This dominance was built on purpose, and the blueprint for it is hidden in plain sight, right inside Canada's tax code. And that's exactly the secret we're going to crack open today. To really see how this all works, we're going to follow the journey of a little fictional company. Let's call it Maple Mining Co. We'll watch it grow from just a patch of dirt into a global player, and we'll see how it uses Canada's tax system at every single step of the way. Okay, so just like any mining startup, Maple Mining has a big dream and what they think is a promising piece of land. But you know what it doesn't have? Any money coming in. Mining is crazy expensive. You have to spend millions and millions of dollars just looking for something before you ever see a single dollar of revenue. And this, right here, is where the Canadian tax system first steps in to give a helping hand. For a company like Maple Mining, which is just burning through cash with zero income, how it classifies its spending is, well, everything. You see, Canadian tax law basically gives you two buckets to put your spending in. The first bucket is for Canadian exploration expenses, or CEE. That's all the money you spend finding the mine, drilling, surveying, you name it. The second bucket is for Canadian development expenses, or CDE, which is for actually building the thing. Now here's the kicker. Exploration expenses, the CEE, are 100% deductible in the year you spend them. Development costs, only 30% per year. That's a huge, flashing green light to spend money on exploration. So that 100% deduction is a massive deal. It basically tells companies, hey, go ahead, take those big risks on exploration. We've got your back. But there's a problem. A tax deduction is totally worthless if you don't have any income to deduct it from, right? And that brings us to the biggest hurdle for our little company, Maple Mining. How on earth do you raise money when you have no product, no revenue, and your best asset is a tax deduction you can't even use? Well, this is where Canada got really, really creative. They came up with something called flow-through shares. And these aren't just regular stocks. They're a special financial tool that allows a company like Maple Mining to do something that sounds almost impossible. It can literally pass its tax deductions onto its investors. Okay, so here's how this magic trick works. Maple Mining issues these special flow-through shares. An investor comes along and buys them, which gives Maple the cash it desperately needs to go exploring. Then, and this is the genius part, Maple Mining takes that 100% tax deduction it earned and just gives it to the investor. The investor can then take that deduction and use it to slash their own personal tax bill. It's a perfect win-win. The company gets cash and the investor gets a massive tax break. And that simple mechanism is the secret sauce. That's why so much money for risky, early-stage mining exploration flows through Canada. It makes these super speculative investments incredibly attractive. It basically turned the Toronto Stock Exchange into a global ATM for any junior mining company with a dream. So, the flow-through shares worked like a charm. Maple Mining's exploration was a huge success. They found a really valuable deposit. So now it's time for phase 2, building the actual mine. And that, of course, brings a whole new set of costs and a whole new set of tax rules. Building a mine means you're buying really, really big, expensive stuff. We're talking buildings, giant trucks, heavy machinery, the works. Now, in the world of accounting, you get to write off the cost of these things over many years. It's called depreciation. The Canadian tax version of that is called the Capital Cost Allowance, or CCA. So here's the basic idea. The company groups all its big-ticket items, like machinery, into a pool. Then, every year, it can deduct a slice of that pool's value, in this case 25%, from its income. This helps lower the company's tax bill once it's actually making money, letting it get back that huge initial investment. And to make it even better, Canada often allows an accelerated rate for new mines, sometimes up to 100%, which makes these giant projects way less risky from the get-go. All right, so Maple Mining is a huge success. It's used the tax code to find a deposit, fund its exploration, and build a profitable mine. It's officially in the big leagues now, and all that success has caught the eye of a major international buyer.
So let's imagine this international buyer really wants a valuable foreign mine that Maple Mining happens to own. Today, that mine is worth a cool $210 million. But for tax purposes, its original cost is only $85 million. Now, if Maple just sold that mine outright, they would get slammed with a massive tax bill on that $125 million profit.
Ah, but the Canadian tax code has one more amazing trick up its sleeve. Instead of buying the mine, the foreign buyer buys all of Maple Mining through a Canadian subsidiary. And then, after the deal closes, a special rule lets the new owner bump up the tax cost of that foreign asset all the way to its current market value. And just like that, the tax cost is now $210 million, and that huge taxable gain, it just vanishes. Poof, gone.
And the result of that? The new international owner can turn around and sell or move that foreign mine without having to pay a single penny of Canadian tax on all the value that was built up over the years. This tax bump is a massive reason why Canadian holding companies are such incredibly attractive targets for international takeovers. So let's just pull this all together. At every single stage of a mine's life, from a crazy idea to a global acquisition, Canada's tax code is there, specifically designed to build this industry. It encourages super risky exploration with 100% write-offs. It invented a one-of-a-kind funding tool with flow-through shares. It helps companies build the actual mines with generous depreciation. And finally, it makes them perfect targets for global giants with that tax bump.
And this all leads to a much bigger final question. The system, you have to admit, is brilliant. It absolutely works. It has turned Canada into a global mining superpower. But here's the thing to think about. Are these incredibly powerful tax incentives a smart economic strategy to attract capital and build an entire industry? Or are they really just a massive public subsidy for pulling non-renewable resources out of the ground? The real answer, kind of like the minerals themselves, is probably buried pretty deep.